Hello and a warm welcome to the Open Treasury Podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most.
My name is Jason Campbell, Business Development Leader. My guests for today are Jack Large, Editor of CTMfile. It is great to have you back at the microphone, Jack.
Glad to be here.
And Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome.
It's good to be here, Jason.
We are focusing on just 4 themes this week, covered by 7 stories. We'll review ramifications of the war. More importantly, kind of dive in a little bit more into Russia's default. In the economy and taxation, a quick update on the global minimum corporate tax. On the banks, deals and development side, we'll look at neobank troubles and BNP's appetite for acquisitions. Digital currency, we'll examine the strong headwinds. And as always, you can find these articles in the show notes from this podcast or by looking them up on CTMfile. So let's begin with the ramifications from the war. Russia has reportedly made its first default on international bonds in more than a century as a result of broad sanctions that effectively cut the nation off from the international financial system and rendered its assets untouchable. So Jack, I'm going to kick this off to you. And here, I think most expected this default to occur. So in your opinion here, how significant is this default?
I actually think it's not as significant as what the corporates are doing behind the scenes to survive in Russia. The country default is, in a way, it's been costed into the predictions for Russia for the last few weeks, I think. What we're seeing behind the scenes is companies that participate in Russia are finding it incredibly difficult to survive, and they're doing all sorts of things like using Chinese banks to act as their lead bank into Russia and a whole range of other things. The corporate default is just a cumulative effect of this. I worry about it significantly, which either way you look at what the corporates are doing behind the scenes and the country default. I think we're in for a global, well, not recession, but a global impact.
So Craig, I'll ask you this. And, with the default, let's kind of go in how it impacts, not just in Russia's case, but just in any country's credit rating. So how does this impact overall?
Well, normally a default would severely impact the country's credit rating. That's always the case when they've defaulted. However, I'm not sure how many credit rating agencies are still rating Russia. So most of them have stopped rating Russia. So there's no impact on their credit rating because they don't have a credit rating. That would lead me to suggest that this impact is notable now, but it's extremely significant going forward because over the next, let's say, several decades, how are they going to borrow money? At what cost are they going to borrow money on the global markets? There's going to be very limited number of countries who are willing to lend the money. That's a significant item. I agree with Jack, though, on his point about the businesses pulling out is probably a more significant short-term impact. But this default, this is going to be a very significant impact for them over time, not having access to the debt markets.
And investing into Russia is going to become more and more difficult as a consequence of this. I see all sorts of problems coming out of just things like funding an extension to a factory or setting up a new sales team. They're all going to have implications. This is linked with the problem of being taken out of SWIFT, so the international payments are very difficult. Russia's a mess.
Yeah, this is a multiple decade impact. The other issue is that they've provided instructions to send their funds, but they're barred from being able to send those funds. So those instructions aren't moving funds to cover this. So Russia says, hey, we've done what we could. It's brought about by others, but they've defaulted, and this will have a multi-decade impact on Russia.
I could imagine as far as, at one point, once this war has ceased, that type of recovery, not just from a standpoint of the landscape, but just economic, as you said, the decades that could potentially take to repair is got to be quite you got to have a really good, strong game plan to how to get back into it down the road. I mean, again, I know it's all new until that happens, but it just seems like that, as you said, that decades long has got to be extremely fearful, and especially for that economy.
Yep, the Russian population don't know really what's happened. They'll only see it over the next decade and more.
So let's move into the next subject here around the economy and taxation itself. So the U.S. Treasury Secretary Janet Yellen says that once some countries begin implementing a global minimum tax on multinational companies, other countries with a lower corporate tax rate will need to follow their lead or risk losing tax revenues. And really kind of looking at, it was interesting as going through this article and talking about, how this process is semi-moving along, and especially introducing a minimum tax rate of 15%. Craig, I'm going to send this over to you first. Does this have value to the overall economy, having this minimum corporate tax rate?
I'm not in favor of a global minimum corporate tax rate. I think those schemes are built to help countries who are trying to raise a certain amount of taxes, and the fear that people go to locations where taxation is more favorable. I mean, I think money goes to where it's treated well, and taxation is one aspect of it. So from a more free market perspectives, I tend to be against this wholeheartedly. And I guess what we're seeing too is there was a lot of buy-in on that initially with the number of countries, but it's being slow walked and slowly progressed in some large economies, notably Europe, and also the US. So I don't think there's great rationale for doing this from an overall economic benefit to individual countries or to the overall global economy.
I'm sorry, I disagree completely. It's essential, in my opinion, that we get a global rate of tax that is implemented by all the major countries. At the moment, you've got countries like the UK, which are basically a source of global fraud, really. A recent article in the UK was highlighting that it's £5 billion worth of fraud just in the UK alone. But what's worrying about this is that we're not getting the concentrated adoption by countries like Ireland, for example, which is a part of the EU. They charge 7%. Luxembourg charge even less compared to the 15% there. And we're not getting cooperation across the world. I think it's going to fizzle. I think there's going to have to be diktats by people like President Biden, like global leaders worldwide, and they have to follow through. But I'm very pessimistic about this happening, I'm afraid.
When we look at like who truly benefits from this, right? So obviously we know that it's going to be the governments that are going to be having this, trying to get this universal tax rate. But truly overall, like, is there any benefit from a free enterprise or from a corporation perspective? I mean, I get it from a government thing, but I'm just kind of curious who all you feel may benefit and who truly may be harmed by this.
The poor people. The poor are being defrauded of basic tax that would pay for their support. 7% compared to 15% is a huge amount of money. And that's what's happening at the moment.
I think some of the things, if there's actual fraud put in place, there are legal ways of resolving those items. The only benefit I see from common tax rates is there is an awful lot of energy put forth to, minimize tax, move it across, whether it's in the United States, between states, or whether it's globally to put it in lower paying tax regimes. And there's an awful lot of brain power committed to doing that. And that's where there's, how valuable is that? Well, if tax rates are really high in some areas, there's significant value in doing that. But overall, how much value is there? So there's that trade-off between those two elements. Taxing companies at 40% is not the most efficient. And I don't know that you can raise enough funds at 2% to fund everything that needs to go on. So there's this balance and tension. I think it's best solved by countries going different ways, picking different elements that create some kind of balance. And it's that ongoing back and forth, I think, that we see year in, year out, globally and within countries.
So do you think that is this even like a thing that we
possibly would even be able to see as something as a global agreement to a specific rate or anything like that? Or you think this is just a pipe dream?
I think it's going to happen, but it's going to take a while. It's going to take longer than Yellen is predicting. But we've got to do it. There isn't an alternative that makes any sense, in my opinion.
All it takes is a couple large players not to agree to it to break it. So
really, you kind of think it would have to take the world's like top 10 economies to really kind of agree on something or something of that nature to kind of come to an agreement to the table. Then you just kind of push the smaller players into the playing field.
I don't know. I think it's interesting. Some of the comments about this global race to the bottom, like everyone continues to lower rates. And there's different theories on that. Just tax individual income because corporate income goes to it. There's a bunch of different strategies there, that people can use. But it's worth watching because corporations have to plan for this, and they continue to change their structures as there's differences here and there.
I do have one other thing, which is that corporates, I think, should not make the assumption that this won't happen. I think they need to make the assumption this will happen. It'll take longer than you think, but the world is going to do it. There is a building agreement. If you look back 10 years, there was this was poo-pooed. Now it's not. People like Yellen are talking about it. People like the Governor of Bank of England are talking about it. We're starting to get serious players thinking about it.
So transitioning into banks. So according to recent reports, French International Banking Group, BNP, has expressed interest in acquiring ABN Amro Bank, the Dutch-based consumer lending firm with headquarters in Amsterdam that has been government-owned since the financial crisis. So Jack, I'm going to kick this one over to you. So with a potential acquisition on the horizon for BNP, what value would this bring to them as the largest bank in the region?
Well, it's interesting that the article says that one of the reasons they want it is because of their coverage in Northern Europe, which admittedly the French haven't been very good in the sort of Scandinavian area. But what's more worrying about this is I feel they could feel that just buying banks is the solution. Because the problem is actually integrating whatever you buy into the whole group. And that's where the problems are. And BNP haven't, in my opinion, demonstrated the skill to do this. So it worries me.
From acquisitions of banks, when you look at, I guess, from a footprint, is this probably just one of those strategies as far as how does one bank grow its portfolios through acquisition? Is that just kind of think maybe that's BNP's game plan here with this?
BNP Paribas sold, I think it was Bank of the West, sold that to a Canadian bank. So they exited a good chunk of the U.S. market from a retail perspective. That freed up cash. Where are they going to put that to work? So it's in their broader, more adjacent home territory. So, people are looking, how do they allocate capital? Some of the rules and regulations that treat exposures in these, in the EU, for example, is treated as domestic exposure, requiring less capital, less risky. So this is an economic play, just like we have taxation in our last discussion. How capital requirements are determined also factor in changes in how banks relate to where they play and what they do. So the idea of additional acquisitions, roll-ups by banks, we've seen that. We've continued to see that. And that also is occurring at the same time. There's a lot of neobank activity as well. So there's new entrants, and then there's these expansions or roll-ups occurring.
So I'm glad you talked about and brought us into neobanks. So I want to go into neobanks and touch a little bit on that topic there. So over these past, few years, past decade, we've seen a lot of these, fintechs coming into this banking world and creating this segment of these neobanks, and seeing how, in the electronic age that we have and how everything is so digital. But it seems like there's some alarming signs that are coming out of that space and some impeding failures perhaps. And according to a recent research study conducted by Simon Kucher, less than 5% of the 400 neobanks around the globe are recovering costs. So it's indicated that Chime and Varo, two U.S. neobanks, also called opposition challenger banks, have hit some stumbling blocks. Craig, since you tapped into this in regards to neobanks, I'm going to throw this question to you. Let's discuss the strengths of the major players and some of the weakness or vulnerability that we have with the new players into the neobank segment.
I feel singularly unqualified to talk about that in depth, but I will say a few things about it. I mean, Chime and Vero, as you mentioned, they've run into some really headwinds or stumbling blocks, shutting down accounts. Vero lost quite a bit of money, so investors have suffered some of those losses. And I think the idea of what's occurring, with these fintech-oriented institutions is creating some concern, not just among investors to some extent, where there was great excitement about it earlier. But in the U.S., you have the Consumer Financial Protection Bureau making some noises about it, calling them rent-to-banks and some concern there. So you have this situation where more than 1 billion accounts have been opened in these digital banks or neobanks worldwide. In the last quarter, 6 million new customers have come into this sphere. So they're gathering quite a bit of attention. So this is not small. I mean, Chime has over 12 million users, a population of 330 million in the US. There's 12 million users with Chime. The idea of there's new entrants, how do they scale to profitability? You can't stay a fintech forever in the banking space. You have to move to generating income to be properly valued. You can't be valued as a fintech forever, or at least that's my view, or how you're going to continue to raise funds. That's the fintech play. You can absorb and gain market share while losing, and then you have to monetize that by moving to some sort of profit model. That's the issue. It can't be a one play. I offer something easy, and then we gather a lot of customers, and then all of a sudden we're profitable. Profitability oftentimes comes from cross-selling, offering new services, other services that add to profitable relationships.
I agree with that. The issue for me really is that the neobanks don't really understand banking. They understand niches, but when you move into banking, you're inevitably dragged into all sorts of other things. The other worry is that the classic banks are starting to get into their space, back into their space. They've learned how to do this. And a recent Forrester research showed that actually the classic banks, or one, Santander is one that was mentioned, highlighted as being better at the techie tricks and the open banking type operations than some of the neobanks. And this, I think, in a way is even a bigger worry, that actually the big banks, the big standing players are going to come back and bite them. I wouldn't go anywhere near a neobank in terms of investing. I would go for somewhere like Stripe, where they're very focused on just the payment piece. And that's what they do superbly. And they're now bigger than Citibank, by the way.
Yeah, all interesting points there, especially in that banking industry itself, is how do you continue to remain profitable? How do you come up with new product, new entrants, new different ways? And especially as you got cross partnerships and collaborations, is how do you work together to increase that top line to drive the bottom line? So let's go into digital currency. And I know this is a really, really strong, hot topic for many, many reasons in today's world. And I'm sure you both have some commentary to provide on this. And as we look at, Bitcoin in particular here around some headwinds, and I know there's a lot of fear that's going on right now. We've seen this Bitcoin itself has dropped just tremendously over the past few weeks, months, however you want to look at the time frame there. And as Bitcoin battled to hold above a crucial level on Monday, the cryptocurrency market was on edge. Investors worry that issues at prominent crypto players could trigger a wider market shakeout, according to reports. So there are 3 articles in this particular topic here, and I'd love to get some, your guys' perspective on the concerns, perspective on how you guys are looking at it as it is as to today. So Jack, I'll kick it over to you for this one. So if you just want to just talk to me a little bit about some concerns that you see around cryptocurrency.
My concern about cryptocurrency is that it's diverting attention away from the global recession, which is coming, I think, and the other big threat, which is global warming. And we're starting to see central banks being diverted away from their core job of managing a stable currency, because they're having to get into things they don't really know about. Talking to large corporates, large treasurers, they are not going anywhere near the cryptocurrencies. Anything that moves so fast, it's unmanageable in terms of value. One week it's this price, the next week is 20, 30% higher. It's unmanageable, and that's really what worries me about cryptocurrencies. It's a big problem.
When you think of like value itself, and we can just look at Bitcoin as being, kind of that main staple of cryptocurrency itself, right? This lost nearly 60% of its value over this past year and 37% this month alone, which is just like anything else, when it came out of the gates and it became a huge investing, and now the fear of what's happening with it. And it's interesting that you put into even, how does it get more regulated, whether through the central bank or, what that next step in the process is. And Greg, I'd like to get your perspective on this as well, if you don't mind.
Sure. I mean, the volatility issue of, losing 60 to 70% for something as well known as Bitcoin is, part of the nature of the beast, this highly volatile currency. Bring that back to some of the, I'll just call it the failures of Terra USD, creating a market crash, other impacts like Celsius Network, suspended withdrawals after a certain level of market decline. These are levels of volatility. They're creating ripple effects that have an impact on them long term. Now, distributed ledger technology, which is oftentimes used in these currencies, is very good technology, helpful in many ways. And like Jack said, a lot of corporate treasurers aren't doing things with cryptocurrency. They might be looking at wallets. They might be looking at how these are stored. Very few are investing in them. Usually if they're investors, they have some tiny percentage held in cryptocurrency, almost as perhaps as an experiment, but not a main method of dealing with their activity or offering that as a way to pay. As Jack had mentioned, central bank digital currencies are a way of the central banks responding to use that type of tech to keep something stable. This idea of, the OCC in the U.S., the Office of the Comptroller of the Currency, in their semi-annual report, listed a bunch of issues with this. The collapse, the shutting down of trade and withdrawals, depegging multiple stable coins. The value of stable coins is they're supposed to stay really close to $1, stay within like half a cent. Well, they've broken out of that band, and that creates a significant issue. This creates liquidity issues. The market cap has gone down significantly from under 3 trillion, which is a sizable sum, to 877 billion. This volatility is useful to watch, and it provides additional caution both for regulators, for viewers of banks, corporate treasury who may be considering something like this. It's just lots of caution upon caution here with what we see. Underlying technology that support this activity is good, but some of the methods seem quite against what normal corporates would use it for in the current iteration.
Another worry is that the BIS are recommending that the central banks get into this. So they're saying that, they're going to develop an intelligent system so that they'll correctly evaluate the different values between the central bank digital currencies. But they're not looking at the fundamentals of how it's going to destabilize the global economy. I'm a worried man at the moment.
Yeah, I'm pretty sure you're not the only one out there around that. I'm pretty sure those folks who are suffering that 60, 70% drop in some of these are probably in that same boat. So my question and to close this piece out on this segment here is I got to ask you both here. Do you guys find this as what's happening, these trends now, is just a learning curve of crypto trading, or do you think that we're seeing the end in sight of crypto trading?
I don't see the end in sight of crypto trading. There's still quite a bit of volume and activity. I think cryptocurrencies as a broader category will survive and thrive. I think central bank digital currencies tend to make more sense to me than something like Bitcoin. What is it backed upon? It's backed upon other people's valuation of it. That's it. What is other currencies' valuation? Well, it's based upon the full faith and credit of the government entity or the central bank that issues that, and that the government has the ability to tax and raise funds and support that. whereas that's not the case with some of these other digital currencies. So I think there's a number of elements that are different, but in terms of learning, I think there's learn and watch for corporates on this. Individuals, if you're having fun, I guess I would just tell one quick story. In an Uber ride, a ride share, on the back of the seat, the guy had a laminated list about how he can help you with your digital currency trading, and he teaches people at night. So he's driving a car around, and he's teaching people how to trade cryptocurrency at night and how to make money off of it. And that says to me that there's a problem.
The genie's out of the bottle. Cryptocurrencies are here to stay. It's just a matter of how we manage it. I'm not convinced we've got enough stable coin is one phrase, but stability in the way we're doing it.
So as we wrap up this session of Open Treasury, I got to ask each of you this one question: is what is your choice for the biggest or most important story of this past week, and why? So Jack, you being the guest, sir, you can go first on this question.
The fact that the OCC has got in the Office of Comptroller of the Currencies, the OCC, is getting involved, and how the importance of global warming is being overridden by these relatively unimportant issues like the digital currencies. That worries me enormously.
For me, the neobank situation where there's the capitalization, those that are generating profit, the small percentage that are doing that, I think those are significant warning signs in the broader banking area. Some of them will do well. The majority appear that they won't be doing particularly well in this environment, and that's worth noting.
The issue we both come up with is worry about the stability of the infrastructure of our financial system. And that's what we're really putting our finger on. And that's where the concern is.
Well, Jack, Craig, thank you so much for joining today on another great episode of the Open Treasury Podcast. Please subscribe and look in the show notes again for the article links below of what we discussed today. Thank you again. Have a great day. We'll see you next time.
This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.